Hey, my name is Jim Knuth, and I have the privilege of leading our Iowa operations for Farm Credit Services of America. The title of this presentation is The Land Market, a Lender's Perspective. And I think the most important word in this title is perspective. 2012 was certainly a year that needs a good dose of perspective. And what do we mean by that? It's a way of regarding situations or topics. It's a way of thinking about something. It's a sensible way of judging something in comparison to something else. So let's use some perspective as we look at the land market in 2012. We've got a 6-part agenda. We're going to look at a lot of benchmark trend and portfolio data. We're going to talk about a sustainable land value philosophy, the concept of land cost per acre. We're going to talk about interest rates, production agriculture margins, and then I'm going to finish with some final perspectives. So let's get started. This is Farm Credit Services of America benchmark and portfolio data. We have 65 farms in our 4 states of Iowa, Nebraska, South Dakota, that we appraise twice a year. Okay. We also have sales data, over 33,000 sales over the last 5 years, 14,000 plus in the state of Iowa. And the information is not surprising. Very strong, robust market in 2012, especially in Iowa, South Dakota, Nebraska. And the emphasis is on cropland tracts versus pasture, ranch land, recreational land. And then we all know we had a capital gains expiration event. And that drove a lot of activity, seller interest at the end of 2012. Here's the data. This is current as of January 1, 2013. Iowa's at the top. You can see 1 year, about 21% increase in land values. You can contrast what's happening in Iowa, Nebraska, South Dakota with Wyoming. Again, Wyoming very flat. The contrast between cropland and ranch or pasture land. I think maybe the most stunning number on this sheet is the 10-year trend. The 10-year trend, 300%. It's rare, here's the perspective, it's rare that an asset class has a 10-year run like this without some kind of cooling off period, correction, etc. So I think to anticipate the next 10 years will look like the last 10, who knows? Iowa buyer types. Who's buying the land? Who's buying the land? The answer is farmers, by a wide margin. Can you see that? 79%. If you add in local investors, you're at 90%. 90%. What does that tell us? Here's the perspective. It tells us that local capital is driving this market and local competition is driving the market. It's not Wall Street, it's not rich guys from Chicago, it's not East Coast money, West Coast money. Local capital and local competition is driving this market. Sales price as a percent of listing price in Iowa, it's 90%. Constant with last year. Again, 90% is a reflection of a very strong market. Here's the number of sales. The number of sales. For the first time since 2008, we saw the sales volume go over 5,000. Again, I think that was driven in part by the capital gains expiration event we had in the 4th quarter of 2012. We saw extreme activity. Iowa method of sale. The trend's clear, isn't it? At the very top, the auction. That makes sense. If you're a seller, what would you do in a strong market like this? Put it up for auction, right? Who knows what they'll bid? I guess especially if you're in Sioux County, Iowa. Here's a map. You've got a full color map at the back of your packet, but this is the 5-year trend. 5-year trend. Number of sales, average dollar per acre for the 9 regions in Iowa. Again, we're providing this for your benefit. Here's the next map. This is more granular. This is 2012. This is average sales price per county and number of sales. Average sales price per county and number of sales. And the winner is Sioux County, Iowa, Northwest Iowa. 52 sales, nearly $15,000 an acre. We also have some CSR data, crop suitability rating. Okay, this is taken again from our real estate database. We have over 80 professionals who work for Farm Credit Services of America in our appraisal department. We have the most comprehensive real estate database in the state of Iowa. It includes Iowa sales at least 85% tillable, unimproved 80 acres or greater. This is dollar per CSR point. Here's a 5-year trend. You can see that we hit the $100 a point in the second quarter of 2011. Second quarter of 2011, and it's continued to go up from there. And this is the state of Iowa average. So this is the whole state averaged in. Then the next map is broken up with the 9 quadrants. Same data, dollar per CSR point, okay, broken up into those 9 quadrants. And again, what is CSR? It's quality, right? Yield, productivity. So that's the next map. This is yield, corn yield, 3-year average by county. This is 09, 010, 011. We don't have the 012 data yet. This is off of the actual production history of our client base. So when you look at the CSR map and the yield map, you get correlation. Again, correlation between price and quality, correlation between price and productivity. It's not surprising that South Central Iowa has the lowest dollar per CSR because of the yield. This is a heads up. I gave the same slide last year. It's coming, okay? New CSR2. Okay, it was supposed to be released in the fall of 2012. It was. Apparently there were some issues, errors, what have you. They pulled it back. So they're working on that information, and it's to be released sometime in 2013. I don't have a good date. I think the point is to be aware that new data is coming. And again, they continue to tell us that there are some differences between 2 and 10 points. Both. He asked up or down, some of both. And then lastly, here's some portfolio data. This is portfolio data from Farm Credit Services of America. It's $8 billion worth of real estate loans over the last 4 years. A little over $3 billion in 2012. This is the average financial profile and the average loan terms. So if you look at 2012, here's what you'll see. Strong liquidity, cash on hand, a current ratio of over 2.5 to 1, average profile. These are borrowers that are not leveraged, okay? Debt to asset ratio about 35%. And they have strong repayment ability. Debt coverage ratio of 2.3 to 1. And then you can see the loan terms. Average amortization of 17 years. Loan to value of 46%. Average size of $419,000. You can see how that's gone up with the escalation in land values. So what's the perspective there? Here it is. Farmland is being purchased from a position of financial strength. Okay? Significant equity, both cash and collateral, are going into these purchases, and typically the buyers are taking small bites to keep their balance sheet leverage and their land cost per acre in line. Let's switch topics a little bit and talk about sustainable land value philosophy. Farm Credit Services of America has been using a sustainable land value philosophy since 2008. We are managing the risk for both the borrower and the bank. We recognize higher production ag margins without overreacting to them. And again, at the end of the day, it's to prevent the overextension of credit in a rapidly increasing market. Okay? Prevent the overextension of credit in a rapidly increasing market. We've seen that 2 times. Farm ground in the late 70s, early 80s, where lenders continued to loan 85% loan to value, and the recent residential housing fiasco that our country is still working itself out of. There's no reason to make that same mistake again in agriculture. How do we get to that? We first calculate a sustainable long-term profit margin. And for this year, we used 450 corn. Remember, that's long-term. That's not current. Cap rate in Iowa, it's about 3.5. And we get a sustainable real estate value, and then we apply our 65% to that. And of course, those levels vary over our 4 states based mostly on yield and expense issues. In Iowa, that sustainable lending value is between $4,200 an acre in south central Iowa to $5,900 an acre north of Interstate 80. And again, the concept is it's the lower of 65% or the maximum sustainable lending level. So why? Why do that? Why use that credit underwriting philosophy? Because of the great lesson of the 1980s, right? Rising asset values do not repay loans. Okay? I've said that for 3 years. Rising asset values do not repay loans. Here's the math. Here's the perspective. $5,900 an acre times 80 acres. It's $472,000. Okay? You finance that at 5% for 20 years, you got principal and interest of $37,874. Divide that by 80 and you have a land cost per acre for 20 years, $473. That does not include your taxes yet. And again, that assumes all 80 acres are tillable. So perspective, it's not what you paid, it's what you can pay back. Okay, let me say that again. It's not what you paid, it's what you can pay back if you're financing the land. Land cost per acre. This is a simple but very important concept. Your land cost is the foundation of your cost structure. It includes your debt service, principal and interest. Okay, debt service is principal and interest. Real estate taxes and rental agreements. These are your actual cash costs. Okay, actual cash costs divided by the acres that you farm, and the goal is to be less than normal cash rent. There's 3 ways to calculate this. Okay, 3 ways to calculate it. I frankly recommend you understanding all 3. The first one is on land you own, right? Your owned land. That'd be principal, interest, taxes divided by your tillable acres. The second way is to understand your rented ground or your leased ground. Again, that's your rental agreements, your cash rent divided by those acres. And lastly, it's the combination. So it's your total operation. understand how all three work in dynamics. There's 4 basic drivers to land cost per acre. Again, this is a simple concept. It's your debt. It's the debts that you either do or do not have on that land. It's your interest rate. It's your interest rate associated with the land, with the real estate. It's your amortization schedule. The shorter the amortization, the higher your land cost. But that's not necessarily bad if you have the wherewithal to make those payments because you're reducing that debt quickly. But amortization. And then lastly, your rental agreements. Here's a very simple example. I just used round numbers. You start with a producer who owns 100 acres free and clear, so his only land cost is his real estate taxes, right? So $3,000 divided by 100. Then he makes a purchase. You can tell this slide is about 1.5 years old, can't you? 85, but the point is the calculation, not the number. He buys some land for $8,500 an acre, he puts a couple $100,000 down. So he finances the balance over 20 years, principal and interest, $52,000, plus real estate taxes on that 100 acres, plus his real estate from before, and you get $290 an acre. And then lastly, he rents another 100 acres for $400 an acre from the neighbor. Of course, 100 times 400, you get 40,000, you add that to the 58, so you get to 98,000 divided by 300. Again, understand how your purchase and rental decisions affect your land cost per acre. Understand how your purchase and rental decisions affect your land cost per acre. When should you calculate this? Every year. Every year, and every time you're thinking about making a purchase, and every time you're thinking about entering into a new rental agreement. Your land cost per acre should be a constant, fluid, dynamic set of numbers and information that you have top of mind. Again, as you're making land purchase and land rental decisions in this market. Again, the perspective, very simple. Your land cost is the foundation of your cost structure. Land cost per acre helps keep your balance sheet leverage in line, your cost structure in line, because the goal is still to be a low-cost operator. The goal is still to be a low-cost operator. Let's talk about interest rates. That's a good topic, isn't it? Here's a concept I've talked a lot about before. When do we see market highs and market lows? I always ask this question, when do we see market highs and market lows? And I've given you the answer. In the rearview mirror, right? After they've already happened. That's the same with grain prices, interest rates, etc. It's very, very difficult to time market highs and market lows. You can see it in hindsight, right? There it was. Now it's obvious, but not in the moment. So it begs the question, where are we? Where are we today? And the answer is we're at 50, 60-year historic lows. Your interest rate is one of the 4 primary drivers of your land cost per acre. And I want to suggest that it's an excellent time to manage your long-term interest rate risk. Long-term interest rate risk. Interest rate ladder. This is a strategy that many of our customers employ, especially in uncertain times when they're not sure, should I go short, should I go long? What they do a little of each. They put some debt on variable, some debt on short-term fixed, and some debt on long-term fixed. It's a common and effective strategy. We're generating cash in production agriculture, right? So prepayment, it's not wrong to prepay real estate debt. In fact, I encourage it, as long as you retain adequate working capital. Don't dilute your liquidity. But as you're thinking about prepaying This is where many of the mistakes are made. Because a customer will come in and say, I want to pay off my highest interest rate first. And what you should do is, at the bottom of the slide, you should pay off your variable first. Pay off your short-term fixed second and your long-term fixed last. Why? If you pay off your highest interest rate, you probably just disrupted or eliminated your long-term interest rate risk management strategy. In other words, I just paid off my long-term fixed, and when rates start going up, I'll realize, whoop, that maybe wasn't the best strategy. So prepayment strategy, perspective, think about this, understand what you should do and shouldn't do. And then I said at the beginning, we're at historic 50, 60-year lows. The Fed has done some unprecedented things. I'm not sure how long that will last, but I would suggest, again, consider fixing debt that you believe you're going to have there for 10 or 15 or 20 years. Long-term decisions should always be judged by long-term results. And again, here's a perspective. It's better to lock in too early than too late. Too early than too late. Why? I'd rather have you be wrong for 2 years and right for 18 than the other way around. Okay? Wrong for 2 years, right for 18 rather than the other way around. Let me do the math for you. Okay? Here it is. $500,000 loan. I wanted to ride that variable, so I did. I was right for 2 years, and by that time rates had gone up. Now I'm thinking, geez, I better do something because I'm not sure how high they're going to go, and I've got this debt, and so I lock it in. Versus going ahead and locking it in today. And again, you can see the math. If you're right for 2 years, here's your interest rate. $342,000, almost $343,000, versus the $302,000, I'm sorry. So it's a difference of over $40,000. Again, just doing the math on the concept of it's better to be early than late as you think about long-term interest rates. Production ag margins. Here's the most likely scenario, assuming we don't have another drought. When I say likely scenario, it doesn't include a 1 in 50 or 60 year drought. It's the most likely scenario, that higher margins are not permanent, right? Higher margins last for short periods of time. We're starting to think they last forever. Perspective. Margins will normalize over time, okay? Margins will normalize over time. That is a basic economic principle that's true of almost every business and every industry. It certainly applies to agriculture. Why will they normalize? Capital and competition will flow to high margins. Always have, right? Capital and competition will flow for high margins. Everybody wants a piece of your pie. Sometimes when we talk about what repays loans, it's good to talk about what does not. So let's start off with what does not. Optimism. It's not wrong to be optimistic, but just hoping things will go up doesn't do it. Hope. I always say hope is not a strategy. Cash grain prices. $5 corn, $6 corn. In and of itself doesn't repay. It's your margin that repays. You have to consider your expense side. Because what happens with expenses? They always lag the revenue side, right? Typically, expenses lag the revenue side. And we've enjoyed that scenario on the way up. It will be equal as the revenue goes down and expenses lag on the other side. Does that make sense? That's what's happened in production agriculture historically. Expenses lag revenue. We've enjoyed the upside. And of course, rising asset values do not repay loans. There's two things. There's really only two things that repay loans. The first one is the sale of the asset. That's hopefully our last choice, right? So it's margins. It's margins or profitability. Know your margins, know your break-evens. And here's the perspective. Are we in a bubble? The answer, we believe, is yes. But it's not the bubble that you think of. We don't believe we're in an asset bubble. We believe we're in a profitability bubble because we expect production margins to normalize. It would likely have happened in 2012 had we had a normal growing year, correct? Because we had strong plantings. So again, understand the perspective of what 2012 gave us. Understand that margins will normalize. And then let's end with some final perspectives. (2012) was an unusual year. I think we have to understand the perspective. What happened? 1 in 50, 60-year drought. We know that. Unprecedented Fed Reserve actions. QE3, what did they say? We're going to keep buying bonds for, I guess, as long as we need to. Wow. They've never said anything close to that before. Someday that's going to stop. They're talking about 2013. We don't know for sure. We had a capital gains tax expiration event, drove a lot of activity. And obviously we have an interest rate environment at historic lows. So the perspective again is, are these parts of a long-term trend, these events, or are they unusual short-term occurrences? We believe that a number of things that happened in 2012 are short-term occurrences. Keep that perspective. The fiscal cliff. Did we enjoy watching that on TV? A little ticking clock, the deadline. What did we solve? Well, 2 things. I guess we solved capital gains and estate taxes. That's a positive. We at least know some things. What did we not solve? The big rocks, right? The big ones. We didn't have a farm bill. We didn't solve the debt ceiling. We didn't solve deficits. So what does that mean? Expect more politics, expect more disagreements, expect more missed deadlines. I think a lot of political volatility will be in store in 2013. Here's some crop insurance risk management advice. Generally, I would tell you, buy up your coverage level with a harvest price option. It allows you to play both sides of this weather pattern. Okay? Allows you to play both sides of the weather pattern. Why? We know we have a lack of subsoil moisture. So, unlike 2012, in 2013, we have no cushion. We're not going into it with any cushion. We know we're going to have strong planting intentions, and we know very likely the price selection levels at March 15th will be high. Will be strong. So if we get into 2013 and we get the crop planted and we get rain, because we've never had 2 droughts in a row, but I'm not the weather guy, I have no idea. And we have a good harvest, and then what's going to happen? Our prices will likely react to a supply side response. And you'll be glad that I bought up that coverage on those high selection prices back in March. And the other way around is, if we have another drought and you don't have anything to harvest, the harvest price option and the revenue options that you have, you'll be glad you have those also. Grain demand. Grain demand. No one knows really where grain prices are going to be in 2013. But here's what we do know. Grain demand is not tolerant of current price levels. Okay? Grain demand is not tolerant of current price levels. I think we all know we saw demand fall in 2012. What's the old saying? The cure for high prices is high prices. But what do we mean by that? High prices usually elicit 2 responses: demand erosion, and then also a supply side response. When you say a cure for high price, that's what you're really talking about, is you will have some demand erosion and you'll have a supply side response. It's coming. And again, here's the numbers. You can see when demand peaked. Again, this would suggest that demand tolerates very well 350 to 550 corn. And as soon as it rose above that level, you could see the demand erosion begin. That's what the numbers say. Do you recognize that? Same for soybeans. Again, it would tell us that demand tolerates, at least historically, very well $10, $11.50 beans, and as the price gets over that, you start to see some demand erosion. Perspective for grain prices. Agricultural land prices. Again, if you're financing your purchase, it's not what you paid, it's what you can pay back. Okay, I want you to understand that very simple thing. You've heard it one slide before. It's not what you paid, it's what you can pay back. Again, understand and calculate your land costs per acre. The land market. At today's price levels, okay, at today's price levels, purchasing farm ground is a long-term investment. It's a long-term investment decision. This is not house flipping, okay? It's not house flipping. You want to purchase it from a position of financial strength. This is not a high leverage moment. And there's no guarantee of appreciation at these price levels. So be realistic about your future expectations. There are a bucket of land value drivers, but there's really three primary ones. Three. Strong demand, foreign and domestic, okay? Strong demand. Historically low interest rates, and very strong net farm income in the crop sector. Cash, interest rates, demand. There's a bucket of drivers, but these are the three main ones. So what's the perspective? We believe two of the three will change. Okay, two of the three will change. Number one, we believe crop net farm income will fall as margins normalize and a supply side response is realized. If we have another drought, this won't be true maybe for another year. If we have normal conditions, you'll start to see this come in play. We believe this is coming. And of course, interest rates eventually will rise. So two of those three drivers will change. Here's the good news. Here's the good news. Where does it leave us? We believe that much of our land values today are supported by the long-term demand factors. The other good news is buyers and owners of farm ground have made their purchase with modest financial leverage. Modest financial leverage. So even if we have a decline, modest, moderate in land values, most borrowers, most owners, most lenders will be able to weather that with very little issue. That's because agriculture has kept its discipline in this market. Agriculture has kept its discipline in this market. And the very last perspective, as we look back at 2012 and we look forward to 2013, is we are still in a journey in uncharted waters. Most of us have not been here before. It's really difficult to forecast outcomes, grain prices, drought, what's going to go on. Volatility is almost a certainty. So the solution, again, is to use facts, data, information, common sense. Facts, data, information, and common sense to form your own individual situation and your own individual perspective. What's right for your operation? And the last slide, I guess, is 1 minute of shameless promotion. If you want to talk to the largest and most knowledgeable ag lender in the Midwest, you can call us directly at 800-884-FARM. That'll hook you to the nearest office from wherever you're calling, or you can visit us online at fcsamerica.com. Questions?
What's the downside of the Farm Bill being unresolved?
Yes, what's the downside of the Farm Bill being unresolved? I think that it's going to get caught up in all of the other deficit wrangling.
What's the downside?
Well, the downside of that is we probably are going to lose our direct payments for sure. I think most people have said those are gone. But it's probably has a lot to do with the subsidies for crop insurance. Will we keep them? Will they be increased? Will they be decreased? We have strong opinion on that. We believe they need to be kept, because crop insurance is becoming our only safety net.
They're in place for 2000.
They're in place for 2013. They haven't changed. So we have one more year of business as usual.
But the worst case scenario, they eliminate that. What's the bottom line on that?
Well, he asked the worst case scenario. I don't think they'll eliminate the subsidy in whole. They could, theoretically, but they could reduce it. So it would, again, shift more expense to production agriculture. It'll shift more expense to the farmer. The good news that we have in this country, most of you know this data a little bit, is our food costs are about 6% of our disposable income. 6%. And you go, well, okay, what's the perspective? In most of the rest of the world, it's somewhere between 16 and 25%. So think about that. 6% for us, 16 to 25% for the rest of the world. So who benefits from a crop subsidy, crop insurance program? Every mother who goes to the grocery store, right? Stable, safe, reliable food. Of all the things fiscally we've gotten right and wrong in this country, we've gotten this one right, okay? We have the best, cheapest food in the world. So again, that's kind of the talking point that agriculture needs to shout loud and clear. Everybody benefits from having a stable food source. Thank you very much.